Ladies and gentlemen, welcome to the Game of Finance today. I'm very excited to be joined by Daniel Kelly from Viola Private Wealth, where we're going to dive into, a different asset class to property, where we're looking at ETFs, private investments, private equity, which is generally not something a lot of property people talk about or perhaps leave to the end of their journey. And I think today what will be really interesting is to talk about, what they are and the differences and the assets that you have access to invest outside of traditional property for our listeners, but also look at, when should somebody consider potentially looking at diversifying and bringing some equities into their portfolio. And when you get to the end of the journey, is potentially this asset class a better asset class from a return or a risk profile? So, mate, thank you for joining us and thank you for being here.
Thanks for having me, Matt. We're friends outside of this, so it's a bit surreal sitting down and doing a podcast, but it's been a long time coming, but looking forward to this one.
Thank you, mate. But please tell us about Viola Private Wealth. What do you guys do and what type of assets do you specialize in? Being the Chief Investment Officer, I guess, that's your jam. That's what you're overseeing.
Yeah, absolutely. So maybe I'll start by saying what a Chief Investment Officer does. And whenever I say CIO, people get confused between Chief Information Officer or Chief Investment Officer. I set the investment philosophy for our firm. Right? The way that we invest, the way that we approach markets, where we think capital deserves a position in clients' portfolios and where it doesn't. The asset allocation research is particularly important with what we do. And so we're building kind of endowment style, multi-asset portfolios that, are really meant to endure any market condition that we can throw at them over 10, 20, 30, 40 years. Like we have really long time horizons. But in finance, we love terminology in finance and we love to confuse people. So private bank, wealth manager, private wealth, they're all really synonymous with each other. We provide bespoke portfolio construction and investment advice to high net worth and ultra high net worth clients. So typically we're working with family office clients that have, $5 or $10 million or more, all the way up to institutions and endowments. We manage money for a prominent university. So it's a range of different clients, but really they're all looking for the same thing, right? They're all looking for asset quality, diversification, and they're looking to achieve the highest level of return at an appropriate level of risk. And risk management is a really important part of what we do. There are assets out there that can achieve 30, 40, 50% per annum, but the probability of you impairing your capital permanently exponentially increases the higher the return goes. And so the way that we include those assets alongside others, and we use property as well, by the way, so it's not kind of an either or, it's a both conversation. We can absolutely get into that. But we see a lot of wealth from our clients being made from property. I always remind people that the Australian entrepreneur is quite different to the US and European entrepreneur. A lot of money has been made in property in Australia over the last 100 years. And so quite often clients are coming to us looking for diversification away from their traditional property portfolio, or they're at the stage of their life where having, such an illiquid portfolio like property, naturally is inherently illiquid, and you can't sell a bathroom, you can't sell the garage if you're looking for a piece of liquidity. We help them do that.
Amazing. And it's interesting, you talk about, we'll talk about this off camera, I guess, Australia's love affair with property, and we've had amazing returns out of property over the last 30, 40, 50 years. And it's a big part of, what I do with my investments. But if we look overseas, and I guess, in the journey that those international entrepreneurs go on when they're looking at their personal investments, it is very different. Property isn't always the first choice for a lot of those individuals. What do you see out there in terms of the global market, where people, start their investing journey and where they, tend to end up?
Yeah, it's very different in Australia compared to overseas. And so if you look at the UK property market, for example, like a pretty nominal return there is 3 to 5% per annum. If Australia or Sydney did 3 to 5% per annum, everyone would be freaking out like we're going through a property crisis, because Australian property behaves probably more like private equity than property. I remind this, all the big US managers that come out and see us, like KKR and Apollo and Goldman Sachs and Hamilton Lane, I have to explain to them that their products are competing with a marketplace in Australia from a residential property perspective that has performed extremely well. And there is some embedded supply-demand imbalances, I'll call them that, that politicians have kind of put in place that almost ensures that property is going to continue doing well for the foreseeable future, because they try and fix a supply issue with demand policies.
Oh, it's great for votes as well, right?
It's great for votes, but it puts a Band-Aid on the issue and it solves things for about 6 months before prices catch up, and then all of a sudden everyone's priced out again, right? And so when you add leverage onto that, and then you also add onto that a banking system that really is just purely focused on property lending. Like think about the banks in the US, JP Morgan, Morgan Stanley, Goldman Sachs. These are investment banks, right? Very different to the bank construction here. We both worked at Westpac, I think, right?
That's right.
You're
That's
an ex-Westpac alumni, same as me. You almost never talk about investments at these banks, right? It's purely property lending. And that's how they generate their revenue, and they're extremely profitable. But, that gravy train needs to keep going. And so it's created a lot of wealth in the country, but there's a certain point in time when, a family that has made $100 to $300 million from property needs to start diversifying away and start selling off assets. Normally, that's the point at which we come in.
Absolutely. And I guess maybe it'd be great to understand, the different types of asset classes that you traditionally see from an investment standpoint for the listeners to understand, what is actually out there. Because I feel like there's probably a view that, this type of investing is just for the uber rich, and perhaps there is wholesale and retail limits to how much you can look to put in. But what are the verticals in terms of what asset classes you can actually invest in that you see?
Very good question. And I always, regardless of the sophistication of the room that I'm talking in, and sometimes I'm talking in rooms that are very sophisticated with CIOs and heads of alternative
You're not today, mate. So you're
good.
Dumb it down for me.
You know what you're doing. But there are two broad categories of asset classes. There are traditional asset classes, which are stocks, bonds, and cash.
Mm-hmm.
And then there are alternative investments. Property actually sits in the alternative investment category.
Got it.
Because it is equity ownership in a private asset.
And that's something like a REIT or something like that, or
that's your family home. You own equity in your family home. Your family home can't be listed on the stock exchange. No one can come and buy and sell it or put a price on it daily. Therefore, property is in the alternative investment asset class. So in the alts category at Viola, we have 5 very clearly delineated sub-asset classes. The first is private equity and venture capital, which is owning equity in private businesses. So the best example of this is SpaceX. So Elon SpaceX, right? And Anthropic, Claude, obviously taking over the AI world at the moment, and even OpenAI. All 3 of those businesses are private. If you opened up your ComSec account and you wanted to go buy shares in SpaceX, you can't do it. It's not a public company. And some of the best businesses in the world now are choosing to stay private for longer because of the short-termism of Wall Street. You don't have to report every quarter. You can kind of take a longer term time horizon like you're doing with your business, right? Like you don't need to go and present necessarily a monthly report to a board committee. You can think 5, 10, 15 years in advance. So the first is private equity and venture capital. We make sure that clients get exposure to that asset class because private equity is the highest returning asset class of them all. You're typically expecting 20% plus per annum from that. The second is private credit and private debt. So this is lending to private corporations, and in Australia in particular, it's property development opportunities that the banks it's not that the banks don't want to lend capital to this, and we would have seen this a lot at Westpac, right? It just doesn't fit the checklist that they want to do on that particular day because of the regulations or whatever APRA and ASIC is doing. But it's not necessarily that borrower is risky or riskier than an alternative borrower. It's just the bank has decided that they want to go after primarily mum and dad, buyers of owner-occupied properties or investment properties. The third is property and infrastructure. And we can absolutely talk about how we invest in that. It's primarily unlisted investment trusts that we go into. So we're not necessarily going into single asset property deals. And infrastructure, you can kind of think of infrastructure as like untenanted property that provides a service or value to society. So toll roads, airports, harbors, the bread and butter real assets that make an economy, kind of tick. We've then got hedge funds, which is a very complicated asset class and probably not something that an individual investor would go into unless they were quite sophisticated. And then there's a fifth category, which we call zero beta alternatives, which is where some really esoteric and niche strategies sit in this class that don't fit neatly into any of the others.
Never heard of that. So yeah, please go on.
It's a term that I came up with actually. So,
got it. Okay.
And it's to capture everything that we couldn't really categorize in the other 4 categories. So it's things like music royalties, litigation lending, water rights. So really interesting bespoke strategies. But the reason why we call it zero beta meaning correlation to public stocks, it has almost no correlation to public stocks. So a litigation lending fund, really interesting, right? It's actually providing financing to law cases that have a really high chance of success. It's just the person actually putting that litigation forward doesn't have the money to put it through the court system.
Got it.
Because it's really expensive to do it. So they might have a case against Coles or Woolworths or whoever it is, but it will take $1.5 million to put it through the courts.
They need that bankroll, right?
So they get bankrolled from a litigation lender who will then normally take 20 or 30% of the net settlement proceeds. So if they win, they might get a settlement of $50 million. So that litigation lender actually, ends up making a very healthy profit. And, the person putting that case forward actually gets to put it through the justice system, which they never would have before. So that's an example of a really niche strategy that we would put into a client portfolio for the right reasons. But we like that category, and we like the hedge fund category and all the other private market asset class categories, because it doesn't matter what Donald Trump's doing. It doesn't matter what inflation's doing. It doesn't matter what interest rates are or GDP. These asset classes are uncorrelated, and that provides a really resilient ballast in the client's portfolio.
And do you guys have, I guess, a balance fund that you build across these different asset classes? Or are you looking at, I guess, direct investment to build, I guess, that asset allocation for a client? And is there minimum levels that I guess you see that you need to invest in terms of parcel of funds to access these different types?
The minimum investment parcel is a really good point, right? And so everything that I just said across those 5 categories, if we rewound the clock 10 years ago, to get into some of the hedge funds that we can now get into with minimums of 50,000 Australian dollars, you'd need to show up with a check of 10 million USD to even talk to the manager. Technology and the democratization of alternatives has meant that even quite low balance clients can invest in the way that the largest pension funds, endowments, and institutions could. So it's kind of leveled the playing field, right? Which is fantastic.
Yeah, it's great.
It's fantastic. The primary inhibitor for a client to get access to these things is knowledge and awareness. And that's where we kind of come in. But to answer your question, we don't have portfolios A, B, C, D, and client just picks one off the shelf and there you go. It's kind of like just a copy and paste approach. We build every single client portfolio bespoke based on what that client needs. In the same way that I think with Evoke Capital, you do the same thing, right?
Yeah, correct. There's no one solution.
Yeah. And so there might be similarities, right? And a lot of the time we're using, similar funds or asset classes across client portfolios because we like the job that they do. And we like the fund manager and they produce good returns. And so we're, of course, going to reuse that manager across most scenarios, but no one portfolio is the same. So you could have a family that comes to us and says, we're looking to generate, a yield of 8% per annum. We have no capital growth ambitions. We just need to generate a really healthy level of income.
Because I think that's a good point, because sometimes when we're looking at investment return, there is sometimes a reference to the capital growth, then the income that you may earn out of that as well. So
yeah, it's a trade-off, right? It's a trade-off. So if I was to think about like a balanced portfolio, for example, without taking excessive risk and putting it into, speculative startups or things like that, golden rule of thumb is generally a 12% total return, right? As in capital growth and income, of which about 3 to 6% is income. Harvard and Yale manage some of the largest pools of private money in the world. The Yale endowment's about 50 or 60 billion US dollars, and that's been compounding at about 13.5% for 40 years, right? So that kind of is the upper limit of what you can do without starting to push the risk, into an area that we'd be uncomfortable with. But then you can kind of tilt it more towards capital growth. So if we're just going a pure capital growth play, we could build a portfolio for a client that's targeting a 20% per annum. I do that with my own money, right? So I'm young, I don't need any more income than I'm earning at the moment. And so I'm purely focused on growing my capital base as aggressively as possible. And so I'm going into those asset classes like private equity and venture capital and some selective hedge funds that have a total return focus. If we're building an income portfolio for a client, then I'd say the upper limit from a yield that you can get is about 8%, again, before you have to either start going down the capital stack, taking more risk, or going into...
but that's a phenomenal return, right? Like 8% is fantastic. And I think, that's...
Pure cash flow too, by the way, which is important to point out. So it's not quite the same as saying a property has a yield of 8%, because there's obviously a bunch of costs and expenses that you need to pay.
Correct. Resi, if it's a gross yield versus, commercial, is it a net? And again, this is before tax.
Exactly. Yes, exactly right. So one of the main reasons why, and we've touched on this a couple of times, one of the main reasons why there is a point in someone's life at which they switch over from owning a property portfolio and they start to progressively sell off those assets and start to do more of the stuff that we do, is because there's not a lot of holding costs for what we do. They're financial assets. So there's no real estate manager that's taking, 5.5% of
no
the
strata,
income.
no insurance, no land tax.
Yeah, exactly.
Bane of my existence.
Yeah. So I created a spreadsheet that actually calculates the net present value of all of this. I might share it with you afterwards. You might be able to use it with your clients. 30 to 40% of a property's gross yield ends up getting eaten up by kind of fees and expenses. And so if someone is literally just looking for an income stream to retire off, that's when they normally come to a group like us and maybe sell their property portfolio that's 10, 15, $20 million that they've developed with someone like you that's been holding their hand to say, okay, now we just need to generate income. Don't blow up the money, right? I worked my whole life for this, right? So don't blow up the capital, but generate me a level of income that's above what term deposits and cash can do, or above what the yield on CBA is if you bought the equity in it. And we specialize in that.
And see, that's interesting because I think what we find, I guess, with the majority of clients that we talk to is, they're, say, late 20s, early 30s, earning a good income and really want to look to invest in their future. And they're often torn between, they've got the share portfolio, they've done some crypto stuff, but they're coming back to property because they want to use that benefit of leverage. And it sounds like for yourself as well, in your journey, property's been a big part of the journey to date, and now you're looking at diversifying into those different assets, potentially leveraging, some of the equity that you've built. So if we were to talk about an investor, starting their journey, do you think, shares or equities is something they should be looking at off the bat in terms of when they're saving for that deposit? Or do you think it should really be property focused and I guess taking advantage of, leverage to get that level of capital into the market and then really look at perhaps, towards the middle to the end of their journey, diversifying? What's your view?
Very good question. I think a lot of people are going to want to listen to this. So there's right things and wrong things to do at different phases of your journey. With the pace that Sydney property increases, or any Australian state, to outsave the market is incredibly difficult. So my advice to someone that's saving for their first deposit is put that money to work. Put a reasonable amount of that money to work. Save some cash aside for a rainy day or if a medical expense comes up or something like that. But go into a diversified index fund or something like that that's actually going to help you either outpace the price increase for the property that you are looking at purchasing. But I still think that for someone in their mid to late 20s, it's really important to get their foot on the property ladder, because you touched on leverage, and leverage is a very powerful force to be used with caution, because there's a very famous saying, ladies, liquor and leverage.
I've seen that on a hat, I think.
Yeah. I think there's someone we know that puts that on a hat, right? So Charlie Munger is the guy that, Warren Buffett's right-hand man, said that those are the three ways that smart people go broke, right? Ladies, liquor, and leverage. So you need to be cautious with leverage, but having a property base gives you a really strong pool of assets that you can regularly value, that the bank will lend you very high amounts on, 70 to 80%.
And frequently LVR. Too, every 6 months, without cost.
Exactly right. And it's especially easy if you've got a mortgage broker, right?
Correct.
So doing that allows you to leverage the asset base, but it's not necessarily the correct decision just indefinitely to continue racking up properties 5, 6, 7, 8, 9. Like I said before, I would encourage people to start to educate themselves on the big world of investing outside of cash and property, which is what most Australians know. And at a certain level of wealth, they can come to a firm like us and we can kind of, advise them. But at Viola, we put out as much educational content on this as possible to make people aware of this, because I think it's just good for the economy. I think it frustrates me with wealth management firms that are experts in what we do, that they kind of gatekeep all these secrets as if not talking about it is somehow going to, generate more client leads, or we're taking money off other people.
I agree.
It's
People
right?
hear private equity and they think, oh, uber rich, like a very exclusive, back, office deals through mates of mates of mates. And, that's not necessarily true. It can be very accessible through the right channels, but I think it's also very important at the right time. So I use an index fund just for some diversification. It's actually my buffer money. So every quarter I'm putting money in a VDHG, Vanguard, high growth fund, which for me just gives me, I guess, a view of, okay, well, if anything were to happen from a business perspective or personal or whatever it is, I can liquidate that tomorrow and I can have cash ready to cover my bills and do what I need to do. I didn't have the luxury of that buffer to start with because I put all of my eggs into the property basket. And I guess for me, I use that leverage to build that capital base from the age of sort of 22 onwards to today. And it served me very well. But I think for the clients that I talk to, it's very important for them to learn about investing and understand the asset classes. But we really push to understand, well, what do we actually want to achieve? If we're going to spend all this money that we're earning, so we're working super hard through our business, through our job, we're going to put it into these asset classes. What do we actually want to achieve? And what is that end goal? Is it to, own your home unencumbered? Is it to earn X amount of money per annum? And I think once we get to a point where we can quantify that goal, that's when we can be really, really clear in our strategy, and if it's using property to start with, and then getting to a point where perhaps we're diversifying into commercial, potentially into private equity, into different funds to give us, I guess, that, spread that we're comfortable with. I think that's really important.
Super important.
And it's interesting you're saying that, property was a big part of your journey to start with, but it's
still
something
it will continue to be. Like I'm going to, it's not that I won't ever buy more property. I'm absolutely going to continue to add to the portfolio. I'm just doing it alongside some other things. I'm doing that. So I'm doing that personally now. So I just refinanced a bunch of investment properties that have done very well over the last 5 years. Going to be putting a bunch of money into private markets.
And talk to me about that. I guess, why did you feel, because you're still a young guy, right? Why for you at this point in time do you think that providing that diversification within your own asset allocation is important?
I'm not as diversified as probably what we would do for a typical family, because my level of financial sophistication is naturally quite high being a CIO. So I can kind of pick the eyes out of the asset classes that best serve me at the moment. What we were saying before, like I don't need income, right? So I'm literally investing in no asset classes or funds that generate income. I'm looking for the highest total return possible that isn't going to compromise my capital. Private equity and venture capital is where almost, all of my marginal dollars are going at the moment.
And because on those asset classes, while I guess you're using leverage and you're not, say, re-leveraging that asset class you're buying, those assets potentially have leverage within them, which they're using to accelerate their returns already.
Yeah, absolutely. And so if I would say when you're using leverage to fund an investment portfolio, diversification is really, really critical. Like I'd never advise someone to go and borrow $1 million from the bank and then invest in 2 or 3 stocks, right? That is how you go broke, because it will seem like a fantastic idea at the time. All ideas seem like a fantastic idea at the time.
Until the world throws us an uppercut. Like there's plenty out there today.
Yeah,
right?
The world is chaotic and it's volatile, and you'll be right in your thesis and wrong in your timing almost every time. And so asset diversification within the funds and then also across funds is super important to make sure that you're not going to impair yourself to a position where it will take 5 or 10 years to catch up. The screening that I do on behalf of our clients, and then obviously I leverage some of that for my own personal balance sheet as well, ensures that we don't do that we're not impairing, capital. And it's important when you're using cash to fund investments, but it's even more important when you'd be left with the long tail of debt that will outlast the portfolio if it goes to zero, right? So it's really important.
Absolutely. And I guess for the people at home, if we use debt to invest and we need to liquidate that investment because it hasn't provided us the adequate return, and we're left with that residual debt, that is non-deductible debt. There is no asset still behind that, right? So that's where, we talk about, I guess, your home loan being that non-deductible debt that we really want to focus on and we want to clear. But if we're not strategic and we're not looking at our investments through the same lens as we do with property, ensuring we're making measured, I guess, decisions, you could be putting yourself in a position where you're going to be sitting on debt that you need to, if you're PAYG, pay with after-tax dollars for a very long time to clear.
Yeah, exactly right. And so with a portfolio like we build, although some of it is real assets, like a lot of it's not. It's financial assets like, ownership in securities and funds and things like that. I'll tell you a story. So when I first started at Credit Suisse, so Credit Suisse was a 165-year-old institution. I joined it 2 years before it collapsed. So I was inside.
What year was that?
It was 2021, 2022.
Got it.
Right?
Got it.
So very instrumental as far as like what I learned in my career, because
Amazing
I was too
learning.
young for the GFC.
Yeah.
Right? I was still in high school during the GFC, right? So that was basically my career personal GFC.
For sure.
Sitting inside a massive Swiss investment bank when it was collapsing. And one of the first things that I had to do when I got there, so I inherited a portfolio of clients from an advisor that had left. So I was managing the money of very wealthy people. And I had to start selling into margin calls, because the portfolio that the previous advisor had set up, some of these positions were bleeding badly, and the client had funded this with what they call a Lombard facility or a margin loan. And when you get margin called, you have to meet the margin call.
Absolutely.
And they don't give you much time to do it. And
how long do they give you?
It's normally like close of business.
Got it. Okay.
It's like, they're not going to say like, oh yeah, we'll give you a couple of weeks to sort it out. Like, we'll see what happens. It's like, you are over your leverage limit. Please pay immediately. selling into a margin call is one of the worst possible things that you could ever face as an investor, because normally that's exactly the wrong time to sell. That's when you want to be buying assets when they're trading at distressed prices. And you get this thing where it's a spiral to the bottom, because you sell into a margin call, it solves that situation for that day. If the market legs down again, guess what? You got to sell right back into that margin call again. And you can permanently destroy capital. And sometimes markets bounce back 2, 3, 4 weeks later. But guess what?
You're out.
You're out.
Yeah.
You're out, right? So leverage, you need to treat leverage with respect, dignity, and use it cautiously. The good thing about property is you can't be margin called, right?
Correct. I guess, it's highly unlikely, I guess, unless you're in default, that property has gone backwards, unless you've made, a very, I guess, big error in terms of asset selection.
Yeah.
So,
But even if someone bought a property, right? I mean, correct me if I'm wrong, because it's been, 5 or 6 years since I've done property lending like you. But if someone bought a property and the price, let's say the world goes through some extreme crisis, price drops below their purchase price, as long as you keep paying the mortgage, the bank's completely fine with that.
Correct.
You
Absolutely.
have a long-term time horizon to allow things to recover with more liquid assets that are priced minute to minute. It's a margin call scenario, and so you don't get that luxury. So,
and I think that's why people are sometimes more comfortable with property, because you're not seeing the number on a screen. So, where it's like I bought my property for, $1.2 million. And, if we do have a soft market for the next 6 months and it's technically worth 1.15, you're not seeing that on a screen. You can do your RP datas and you can do valuations. However, as you said, as long as you're making those payments, there is going to be no, repercussions from the bank, because you're still servicing that debt.
So that reduction, it's a fantastic point you bring up. And there's this thought experiment that I like to kind of take people through to explain why property is often the thing that generates the most absolute wealth for them. It's not necessarily because property is the highest returning asset class, or it can outpace things like venture capital or private equity or any of those others, or even shares to some extent. The Nasdaq's done 20% per annum for the last 5 or 6 years, way above Sydney property, right? But because it's not priced minute to minute, you're not seeing the emotional volatility of holding that asset. And so people feel very comfortable holding it for 10, 15, 20 years. And people like to kind of sit at the pub after a few beers and say like, oh, I was thinking of buying Bitcoin in 2012. And had I done that, I'd made $400 million. I like to remind them, like, there's no chance you would have held through all of the extreme volatility. So even if you put $20,000 in Bitcoin in the early days, you're saying that when you're sitting there looking at a portfolio worth $150 million and it drops by 40 million overnight, that you're not going to panic and sell?
That was me. Yeah. That was me. So that was me in 2016, 17. I bought 10 grand of Bitcoin. It went to 20.
Yeah.
I was just like, I'm a genius. And I'm going to buy some more. And then 2 months later, it was worth 3.
Yeah.
And I was just, there goes 7 grand. That's nice.
To assume you're going to hold from A to B through extreme wealth creation and not at some point decide to either sell out. It's like the guy that bought, 3 pizzas with Bitcoin in the early days, right?
That's right. 2020 hindsight, right?
I think he got 50,000 Bitcoin or something ridiculous to buy.
It's going to be worth a couple of billion or something. But
so it's completely unrealistic to assume that you would hold an asset like that has such intraday volatility. But it's very reasonable to assume that you'll hold a property for 10, 15, 20, 25 years. And so that's why more often than not, it's not necessarily that property outpaces other asset classes. It's just that people hold it for so damn long.
And I guess with that, so with the clients that you typically see, when is the right stage for most of these clients to say, look at something, like yourself and those alternate investment classes?
Totally depends on the person. It depends on their ambitions.
So let's just say it's a sort of a property investor. We built, $15 million worth of wealth over 25 years. We're carrying, circa $7 million worth of debt. Commonly, we discuss, well, if we want to look to get the yield out of the portfolio now that we've been working so hard to build, we would need to deleverage. So because you probably don't have the servicing capacity that you had, 10, 20 years earlier. I guess, how would you treat that situation for somebody who's looking for income at the later stage of their life?
The family normally comes to that conclusion themselves anyway, right? And so it's a progressive thing. I've never seen a scenario where we've got a family sitting in front of us with $20 million of real estate and they just go to zero and then give us a bag of money. It's more, if they've got that much real estate, they've normally got 6, 7, 8 properties, normally diversified across Australia or sometimes even internationally, and they progressively sell them off when it makes sense to sell that asset off, right? And so they'll start working with us in the earlier phases when they say like, look, we're going to exit out of a warehouse or something that we own. There's going to be about 7 million coming in 6 months' time. Let's start working together on the plan of what to do with that money, noting that the longer term strategy is for them to progressively sell off the rest of the portfolio, and eventually they'll be fully invested in a Viola portfolio, if you want to call it that. But it's not kind of like a overnight decision where they go to zero. Like you were saying, assets in the property space have certain attributes. And so at that point in time of their life, they might want more income. And some of these property might be generating really good net yields, right? So it's probably the last to be sold, where they might have, something that they've only bought recently that's maybe done well, and they're kind of looking at using that to pay down some debt. So it's a progressive thing over time. Normally, we find clients coming to us probably in their mid to late 40s doing that if they've done really well in property. They're probably still working, but they're starting to think about a retirement plan, and we're key to that. And so managing their money inside their self-managed super fund, as well as in their personal name or trust, is part of that. But it's something that can take 10 years to do.
Absolutely, and I guess property is liquid as well. You can move it on, but it's not going to be as quick as hitting a button on CommSec and getting your cash out. And there's tax considerations on which assets. Do I have a $20 million family home that is grossly oversized for what we now have if the kids have moved out? So if we downsize to something that's worth 10, what can we do with the change? I'm sure you see that all the time.
There's also kind of a recency bias that we find with clients a lot of the time. People like to keep doing more of the thing that made them money their whole life, right? So when you've made money in property for 30 years, right, to then make a decision to start changing that strategy, can take quite a bit of convincing.
Oh, it's huge.
It's a huge educational journey, right? And kind of rightly so, right? If you're a family in Australia who's made $100 million in property, it's like you've done really, really well, right? And so that asset class as an expert. To then go and start educating them about all of the other potentially better solutions out there for that phase of their life is a journey that takes a few years. So there's some natural resistance that we get, from property-based families, and they just want to keep doing more developments, and they've made really good money doing it. So we can't, criticize them for it, and we never would. But yeah, we work hand in hand with our clients, and quite often they'll come to us quite unsophisticated with, even if they're a wholesale client and they're wealthy, financial sophistication is quite a different thing, right? And we'll take them on a journey of educating them and explaining what we're doing and why we're doing it. And we don't just take over the portfolio and make decisions for them and not explain how this fits into, like you do, what the greater plan is, why we're buying this, why we're selling that. And then they love that journey as well, because it teaches them how to manage money. And it's really important for the next generation. So we bring, the sons and daughters of our clients into the room, because these are going to be the beneficiaries of this wealth at some point in time. And if we don't kind of bring them on that journey, then they'll blow it up. And it's a shame to destroy a family legacy like that.
What I really hear, it's property for the most part, it is a big part of a lot of people's journey, because I guess, again, barrier to entry, the leverage and the benefits we can get. But over time, I think we need to educate ourselves and we need to look outside. And while, 6% net return from a commercial property is great, and we're getting that cash flow, and if it's a triple net lease, we're not paying the land tax, we need to think about, well, do we have the ability to diversify? Because if we don't, the potential consequences of that, if we have a tenant move on, is massive. If we've only got one asset that's giving us that income, and that's to be our income for the next, 20, 30, 40 years.
I think on that point, right, an investor educating themselves on all the other asset classes doesn't necessarily mean that another property is not the best thing to do.
Correct.
It's just that knowing that it is, and doing the research to know that, cool, I've looked at everything else, fantastic, I'll keep educating myself on these other options, but I am going to go for property 3 or 4 because it still makes sense for me at my stage of life right now. I've got a lot of friends that work in your space, in the mortgage broking space, because I kind of cut my teeth in the big banks. And almost every time it's like we're actually not competing with objectives for the client. It actually, like what you do and what we do fits in together really well.
Absolutely.
So it's not kind of like, people probably traditionally think that you take care of the debt side of the balance sheet, I take care of the equity side of the balance sheet, but it's a collaborative approach.
Absolutely. And I think, that's what I've taken from today. It's not property or shares. You don't have to pick one.
It's a Mexican ad. We're holding up the taco.
That's right. Hard, soft. I don't know the Spanish words, but it's really about ensuring that, okay, what is our end goal? And do we want our end goal to ensure that it has as little risk as
trying to
possible?
make money, right?
Exactly.
We're just trying to make as much money as we can for our clients.
If we need $500,000, in 20 years' time to feel secure and give us the lifestyle that we want, what assets do we want to see feeding that income figure? And if we have, 40% coming from, shares and investments, and we've got 60% from property, or we've got some coming from just our superannuation fund with whatever we've invested there, happy days. But we've had that conversation and we've taken a risk adjusted approach to planning for our retirement.
So if I can ask you a question, so with your personal balance sheet, how much of that other investing do you do at the moment, or is it kind of just it's cash and property? Like obviously you're very, very exposed to property.
From a percentage,
You're still doing the share.
I still am every quarter. Okay. So every quarter I'm putting money into an index fund, putting a little bit of money into crypto, but more so just the ETF.
Yeah.
But I would say probably 5% of my net worth is in shares. And sort of
that's like the
alternative
liquidity sleeve that if you need to call
correct.
it.
Yeah. So that's inclusive of super, which I can't touch, but there's a big chunk outside of that as well. So for me, again, it was purely just buffer, a little bit of diversification, but the equity that I get out of the properties, for the moment, it's still going into the foundational portfolio. So for me, like my view at the minute is I want to get the foundational up to about sort of 14, 15 mil, which if I sort of close on these couple of purchases, will be there in the next couple of months.
Fantastic.
And then from there, it's really commercial, still feeding sort of the share portfolio as well, with the view that when I do look to divest from resi, say in 10, 20, 30 years, whenever the time is, I'd look to deleverage the commercial to a level that I'm comfortable with from an income perspective, but have that change that I could choose alternative investments as well. And the concurrent strategy there is really paying off the home. So I did buy a home. I did rent-vest for over a decade, but I did buy the home, and I was fortunate to.
Don't worry.
That's all right. He knows. He sees everything. But I did that, and I guess accelerated the repayment of that home, and then really debt recycled and invested in businesses and property. That's sort of where the lion's share of my wealth is. In time, I'll probably want to upgrade that owner occ, and because I've already, I guess, paid off a significant amount of the cash the debt, going to rent vesting is not such a, I guess, compelling case, because I've already done that work to pay that tax, to pay off that debt. Sure. So that's where, for me, I guess if I do go to upgrade that home, a concurrent strategy is going to be looking to really eliminate that debt before the exit horizon. So any of that cash that I get out of deleveraging can be purely for investment and purely about bringing out yield from those fixed assets.
You actually have, so maybe without even knowing it, through your business, you have a very large exposure to private equity already anyway. Right?
Yeah, that's true.
You've created a very successful mortgage broking business. It's great seeing what you do, man.
Thank you, mate.
It's amazing seeing what you've done over the last few years. You work very hard for it, so it's fully deserved. But the business itself will be worth quite a bit, right? And so that's equity ownership in a private business, therefore private equity, right? So you're actually kind of maybe.
I'll take it, mate. I'll update my LinkedIn CV.
Private equity investor.
That's it.
So, like as an owner and founder of a business, people often forget that it's like, that is a financial asset that you are owning and nurturing. You just have control over it.
Correct. And it could be saleable. Not every business is, but there are some businesses that are, lendable and saleable, where, that could be a significant exit horizon where we look to pivot and deleverage or put it into different asset classes.
Yeah, absolutely.
So, mate, just to close, I guess for somebody listening who is potentially looking at diversifying away from, I guess, just property and adding an element of ETFs to their portfolio, or looking to engage a fund manager if they're later in their property investment journey and looking at diversification, what are 3 questions you think they should ask?
The first one comes down to alpha. So alpha is a term in finance that really just means, has a manager outperformed the benchmark that they're holding themselves accountable to? So whenever we're looking at a new prospective investment, I want to ensure that that manager is actually justifying the fees that they're charging us to go into that fund by beating the benchmark. And it's pretty commonplace that 80 or 90% of fund managers out there don't beat their benchmark, and you're actually just better off investing in the NASDAQ 100 or the S&P 500 or something like that. So evidence of alpha is extremely important, because if they can't demonstrate a long track record of doing this, not over 1 year, but of over 3, 4, 5, 10 years, then I'm already betting on a turnaround story from day one.
Got it.
Because they're charging us a management fee and a performance fee to do something that they've never been able to do before, right? That's the first one. The second one is we want to see the manager putting their own money behind our client's money. So they're actually investing in their own strategy themselves in a meaningful way.
Is that something they need to disclose, or?
They don't necessarily need to disclose it, actually, but it's always something that we ask them because...
Yeah, skin in the game.
Skin in the game. If they don't believe in the strategy enough themselves, then it absolutely doesn't deserve a place in our clients' portfolios. And we also want them to not only make money, right? Like we want to see superhuman levels of incentives for these fund managers to be giving it their absolute all every day, doing 10, 12, 14-hour days sometimes. These guys are pretty hardcore. We want them to make a lot of money, but we also want them to hurt on the downside. So when things are going bad, we want them to have that skin in the game so that they're incentivized to really pay attention and actually, turn that ship around. And the third thing is portfolio construction. Make sure that it's not in the documentation that they can concentrate the portfolio into a single asset, or that it has a sufficient level of diversification. So a really good example of this would just be the IVV S&P 500 ETF. It's going to hold 500 stocks. It's in the name, right? That ETF is never going to be a 10-stock portfolio or a 5-stock portfolio. But when you're going, into an active fund manager, they can actually move and ebb and shift the portfolio quite a bit if you don't read the documentation. And so the thing that you invested in on day one can be quite different 3 or 5 years down the line, but you assume that it's doing the same job that you initially came to them for. Right?
Got it, yeah.
So with what we do, due diligence is extremely important because we don't just invest in listed ETFs. We invest in a lot of private market asset classes that have the ability to generate higher returns, but they're quite opaque, meaning you actually need to do your research. So before we put any client into a fund at Viola, I have to prepare, it's about a 25-page investment committee report on the fund. It takes about 60 hours to do. It's extremely extensive. I even look at the track record of the individual principals before they started the fund. Where were they? What were they doing? Was it something different? And it's really, really important because asset quality is how you ensure that you don't impair client capital. So those are probably the three things I'd say: alpha, skin in the game, and then diversification.
Amazing. Mate, thank you so much. That was unreal. Like, I've learned a hell of a lot. I think, in terms of my strategy, I'm going to keep buying property, and then once it's doubled and tripled, I'm going to come and see you, and you can figure it out. So, but you'll probably be well retired by then.
I'm going to buy another property, so I might give you a call.
There we go, mate. I know a guy.
Nice.
But Daniel Kelly, mate, thank you very much for being here.
Thanks for having me, mate.